Joining me right now is Independent Advisor Alliance Chief Investment Officer Chris Zaccarelli. Chris, great to see you. Thanks very much for being here. I guess the big event in recent days is this Bank of England intervention yesterday. And I want to read you what Piper Sandler's analysts are saying. Here's the headline. The BOE's actions, which is the temporary restart of quantitative easing, shows that central banks take financial stability seriously. And that is exactly the sentiment that Wall Street has followed. In other words, if the markets crash enough, maybe the Fed pivots. What do you think?
Well, I think you've seen that in England. They've had to do that. But I don't know that the Federal Reserve in this case is going to pivot at all. I think they really are serious about fighting inflation. You've seen them continue to raise rates, and they've been really showing that they're going to try to get those Fed funds rates above the rate of inflation. We've got that important inflation number coming out tomorrow, as you mentioned, the PCE. It was 6.3% last month. They're expecting it to come down to 6% this month. But 6% is still well above the 3.25% we're at now on the Fed funds rate. And even if they get to 4.5% by the end of the year, we're still going to have a Fed funds rate that's lower than inflation. So I think the Fed has a lot more work cut out for them. They have to focus on inflation before they can come to the help of the markets. And that's what's different about this cycle versus the ones we've seen in the last 15, if not 20 to 25 years.
Yeah, and also different than what you're seeing in England. Dagan, we're hearing the same sentiment out of the Federal Reserve. They're going to stick to fighting inflation and taking interest rates higher. Your thoughts?
Chris, I don't understand why investors were so giddy about what the Bank of England did yesterday rather than being frightened.
I agree with you. It was a little bit surprising that people were so willing to buy the dip yesterday when clearly the problem is inflation. There's a much bigger problem in front of us than what we've had previously, and I think you're exactly right. The inflation fight is going to be difficult because people are so used to buying the dip. They're so used to the Fed coming in and buying bonds when things get tough. Unfortunately, the Fed doesn't have our back this time like they have in prior times. And investors are going to have to understand we're going to have to deal with a higher rate environment for some time to come. And we're potentially heading into a more traditional recession where you're seeing corporate profits go down. So investors are going to have to adjust to what we're seeing on the ground. And unfortunately, the volatility is much more likely over the next year than people are probably thinking. They're thinking the worst is behind us. That may not necessarily be the case. We don't believe that's the case.
And I don't think inflation has peaked, frankly. I mean, sure, we're seeing demand destruction in some areas. Look at housing. Mortgage rates are up again yesterday to 6.52%. That's the highest in 22 years as pending home sales fell to a 2-year low. But, John, let me get your take on this because the GDP is out this morning. And a lot of people point to the fact that oil has come down, and that is indicative of inflation peaking. But oil has come down because demand has slowed. We see that in the GDP numbers. We're going to see that again this morning.
Yeah, that's exactly right. And energy is only a relatively small component of the CPI and other price indices. You know, for instance, rents take up about 31% of the CPI. They're not coming down anytime soon. Investors have to accept the reality that we are not going to contain inflation. We're not going to conquer inflation unless we pay the price of a recession.
Chris, you agree with all of that? And how do you want to allocate capital in this environment?
Unfortunately, I agree with a lot of that. I think we are going to have to go through a recession in order to get inflation under control. It's pretty entrenched. People have plenty of money to spend. They've saved all that money during the pandemic, and unemployment is really low. Unfortunately, unless unemployment starts going higher, inflation is likely to stick around because consumers are going to keep spending. In this environment, I would say you do need to prepare for a recession to some extent. Obviously, there are great companies that are going to make it through a recession in lots of different sectors. The typical playbook is to go to utilities and consumer staples. Unfortunately, those are very expensive parts of the market. We would favor healthcare in this case. Healthcare is a great sector where you have some inelastic demand. Obviously, even during a recession, people are going to pay for medical care as necessary. So we would look to the healthcare sector as opposed to utilities and consumer staples, all three of which are typically good through recessions. But specifically healthcare, we think it has attractive valuations. So that's more where we're leaning in terms of the recession playbook that we think is going to unfold over the next 12 months.
Well, Chris, good to see you. Thanks very much. Chris Zaccarelli weighing in. We'll talk soon.